The FDIC currently has $100 billion to cover over $19 trillion in deposit. So the question is, can the FDIC go bankrupt? Well, if you watch this video, I'm going to explain if the FDIC insurance will be able to refund your deposit during a major banking collapse. Hello everyone, today we're looking at a topic that is very important for anyone that keeps money with the bank. This video was inspired by a comment that I received from my video on the difference between traditional banks and credit union. And in that video, I also explained why it's safe to bank with credit union, especially in today's uncertain economy. Well, click on the link if you want to watch. But before that, I need you to watch this video first, okay? I need you to watch this video first. When you're done watching this video, then you can go over and watch the other video. But today we're looking at whether the FDIC will be able to cover all depositors in a major banking collapse. But before we dive into the topic, let's first understand what the Federal Deposit Insurance Corporation is and how it works. The FDIC is an independent agency of the federal government that was created in 1933 in response to the Great Depression. And the primary role is to protect depositors in case a bank fails. FDIC does this by insuring deposits up to a certain limit. And currently, the FDIC insures deposits up to $250,000 per depositor per account type at each FDIC insured bank. The $250,000 limit is much higher than anyone has in cash in any bank, except the wealthiest people, of course. So the FDIC protects smallholders or the average person. In essence, it doesn't protect the wealthy or large corporation because they generally put their cash into treasury bills, which are not insured, but they are backed by the full faith of the U.S. government. I have said this before, and I repeat that you need to diversify and have multiple bank accounts, especially if you have more than $250,000 in liquid cash, regardless if it's a personal account or it's a business account. It's just a smart thing to do. So the question that we are discussing today is whether the FDIC can cover all depositors in a major banking crisis, right? And to answer the question, we need to look at two factors. One of it being the resources available to the FDIC and the likelihood of a major banking crisis. Now, when I say a major banking crisis, I'm referring to banking collapse with any of the large banks that we know about. This could be Bank of America, U.S. Bank, Wells Fargo. So the FDIC is funded by premiums paid by banks for deposit insurance coverage and by the earnings on investment in the U.S. Treasury securities. These premiums are based on the risk that a bank poses to the FDIC insurance fund. So banks pay this premium as a protection in case they fail. Banks that have higher risk do usually tend to pay higher premiums. And in addition to these premiums, the FDIC has access to a line of credit from the U.S. Treasury. The line of credit is currently set at $100 billion to cover the 4,844 commercial U.S. banks that totals up to $19.3 trillion in deposit, or roughly 0.0005% of all accounts. So with this, the FDIC insurance cannot cover all deposits in the country. But then the $100 billion limit can be increased by an act of Congress. So with these resources in mind, can the FDIC cover all depositors in a major banking crisis? The answer is that it depends on the severity of the crisis. If the crisis is relatively small and affects only a few banks, as the case of SVB or Signature Bank, then the FDIC should not have any problem covering all depositors. In fact, the FDIC has a lot of experience handling these types of situations. Since its inception, the FDIC has resolved over 3,500 failed banks and 563 bank failures since 2000, and he has paid over $100 billion in deposit insurance to more than 1.5 million depositors. However, if the crisis is larger and affects a significant portion of the banking system, then the FDIC will definitely struggle to cover all depositors. So if a large number of bank fails at the same time, all right, then the FDIC insurance fund could be depleted easily. In this scenario, the FDIC would have to rely on its line of credit from the U.S. Treasury to cover all depositors. And if the crisis is severe enough, then the FDIC could exhaust its line of credit, leaving depositors without insurance. There have been bank collapses, and when it did, the FDIC didn't even flinch. As you can see from the chart, the number of bank failures in 2006 was none. But by 2009, it was 140 and 157 in 2011, which was due to the Great Recession, okay? And this wasn't even the busiest year in FDIC history. That was 1989. In that year, the FDIC was dealing with a couple of failures a day. The FDIC doesn't wait for banks to fail either. They consistently perform stress tests on a bank's liquidity. It's the ability for a bank to pay its loan and depositors. When a bank starts getting short on capital, the FDIC doesn't wait for a run on depositors or receivership. They quickly put together a team well in advance to auction off the bank to a larger bank in a secret auction. Then at 5 p.m., right, usually on Friday, it hits all the branches of that particular bank simultaneously, and then they are informed that there is a takeover. The reason why the FDIC doesn't wait is because they know that a bank run will kill a healthy bank as quickly as a sick one. It's their job to keep up the confidence in the banking system. Even if they run out of money due to huge demand, the government will quickly step in to fund them. In reality, the federal government is constantly monitoring all banks and might soon pick up on any bank that might pose problems and take action. It will highly be unlikely that several American banks will fail together. But it was also possible to have a number of major foreign banks with operations in America fail. As a matter of fact, the only time in history that the FDIC balance temporarily went in red was during the banking crisis, which is the Great Recession of 2008 to 2011, which necessitated for the Federal Reserve and the government to step in. But I also want to point out that it takes time between a bank seizure and the sale of a bank's assets for the funds to be repaid. So it's not like you can easily, next day walk into the bank to request for your funds to be paid. It takes a while because there's a process that comes with it. So payments are recovered through the sale of the seizure of the bank's assets. It's also increased the members' contribution to help cover those losses. Entering the 2008 crisis, funds balance was less than half that amount. And it took the crisis of the magnitude of 2008 to temporarily drive the fund negative, and regulators learned the lesson the hard way. The fund is now more than double the 2008 balance. Overall, the FDIC has been able to fund with a negative balance in the past years using a combination of strategies such as borrowing money, as I mentioned before, assessments, managing risk, and even liquidation. However, a negative balance is a serious concern and can have significant implications for the stability of the banking system. As such, the FDIC and policymakers generally work to ensure it remains adequately funded to prevent a negative balance from occurring in the first place. I want to take a moment to give credit to a woman who we all owe a debt of gratitude to, and I mean every depositor in America, and most people have no idea who she is. And if you watch this video to the end, I'm going to explain why in a second. By the way, if you haven't subscribed to my channel, please do that, and also smash the like button if you haven't already liked this video. Well, the lady I'm talking about is Sheila Burr. Sheila Burr played a significant role in the FDIC insurance during her time as the chair of the Federal Deposit Insurance Corporation from 2006 to 2011. During her time, Sheila Burr oversaw the FDIC during a time of financial crisis, including the 2008 financial crisis that saw many bank failure and subsequent recession. She had fixed many of the structural and lack of, expertise problems she had inherited in 2006 and just in time for the Great Recession. She worked to strengthen the FDIC deposit insurance program and ensure that it was able to provide adequate protection for depositors in the event a bank failure is to happen. Sheila also improved the FDIC ability to handle bank failures, including implementing a new resolution authority under the Dodd-Frank Wall Street Reform and Consumer Protection Act, which gave the FDIC expanded powers to resolve large, complex financial institutions in an orderly manner. In addition to her work on the FDIC insurance program, Sheila also focused on consumer protection, financial education, and improving access to financial services for underdeserved communities. She was a strong advocate for transparency and accountability in the financial sector, and she worked to ensure that consumers were protected from abusive practices by banks and other financial institutions. Overall, Sheila played a significant role in shaping the FDIC insurance program during a time of great turmoil in the banking industry, and her efforts helped to strengthen the FDIC's ability to protect depositors, which includes you and I, and ensure that the stability of the banking system. Thank you so much, Sheila Burr, for your public service. Well, guys, do well to watch my other videos as well. Thanks.